We've spent so much time talking about interest rates because the central bank, the Federal Reserve in the United States, the European Central Bank, the Central Bank of Japan, Bank of England, can influence the economy by changing interest rates. Right? So there's going to be a principal interest rate that they can control directly, and that interest rate is going to influence other interest rates within the economy. And because of that, that can influence consumer spending. It can influence especially investment. And in the United States, especially investment in new houses, or what we call residential investment. So, how does this work? Well, we saw before that when Julia faced a higher interest rate, that reduced her consumption possibilities, right? A higher interest rate shifted her onto this blue curve rather than the red curve, and meant that she couldn't consume as much now because borrowing was much more expensive. And we can think about this going throughout the economy. In the United States, this is especially important when people are thinking about building houses, because the higher is the interest rate that you pay on a mortgage, the more expensive that mortgage is. And so you're less likely to build a house, and you're less likely to build a bigger house. So if we put all of those things together in the economy, and we can see that what's going to happen is that as the central bank lowers the interest rate, spending now is going to go up, right? And so that's what we see in Julia's case, and that's what we would expect to see in the economy as a whole. So one other thing that we want to talk about here is this idea of a principal agent problem. And the idea behind a principal agent problem is that there's a principal who wants something done, and then there's an agent who is going to do it, but the principal can't control the agent directly. And this is especially important both in the labor market and in the financial markets, because in the financial markets, the agent is the lender, and the principal is the lender, excuse me, and the agent is the borrower. And so the principal wants to know that the borrower is being responsible, is investing the money responsibly, but they can't know that that's going to happen. And so that means that a lot of projects that might be a good idea don't get funded because of this principal agent problem. And so we can see, both in the labor market and in the credit market, that we have this principal agent issue. It's one of the reasons that we believe workers are paid a higher salary than they need to be in order to make sure that they get some employment rent and work harder. In the credit market, what often happens is that a lender won't lend the entire cost of the project, right? They want to make sure the borrower has some equity in the project so that they will feel the pain if the project fails. That's the reason that home buyers have to put down a down payment. It's the reason that business owners often have to have some equity in any specific project. So another way to think about this is that the wealth of a borrower is going to be very important in terms of whether or not the borrower can get a loan, right? So when we think about buying a house, there's collateral, there's the house itself. And so the value of that house is going to be important in whether or not someone can get a loan. But if we're thinking about a loan for a different type of project, the wealth of the borrower is going to be very important, because uh, a wealthier borrower will be more likely to be able to pay back the loan than will a poor borrower be. Now, obviously, the quality of the project is going to be important as well, but that's not always uh, very observable to the lender. And so, if the borrower has more wealth, has more equity stake in the project, then they're more likely to get a loan. But the problem, of course, is that if you're poor and you're looking for a loan, then sometimes no matter how good the project is, you won't get funded because you don't have a lot of wealth to provide as collateral. You may not have a lot of equity in the project because you have no wealth to put into the project. And so what we see is that borrowing constraints are particularly important and difficult for poorer borrowers. we can think of this really as a credit market failure, right? Is that there could be all these really good projects that poorer borrowers have that would make a lot of money for both the borrower and the lender, but because of the principal agent problem, then those projects don't get funded. There's some possible remedies. We could, somebody like the Grameen Bank that does microloans could make responsibility for repayment a common responsibility. So if you're lending to people in the village, the entire village takes on the responsibility of paying it back. That's, I guess, one possibility. Another possibility could be some government program that guarantees loans. So, for instance, in the mortgage market, there are programs that allow lower income people to get subsidized mortgages because they're backed by the government. But it's not an easy problem to solve. So overall, I think what we want to think about is, banks are both extremely important for the economy, but they also can represent a fair number of costs. So what are their pros? Well, they allow people to save, people to borrow. They match those borrowers with savers, right? So if I'm saving money, I don't have to lend to people directly. I can just put my money in a bank. They engage in what's called maturity transformation, meaning they will lend out for a long time, 3 years, 5 years, 30 years in the case of a mortgage, but they borrow money short. Deposits are often called demand deposits because they can be demanded back as long as they're in a checking account. And so without banks, a capitalist economy couldn't survive. On the other hand, banks can bring a fair amount of problems too. So we talked about credit constraints in this video. We've also talked a little bit about negative external effects, right? So there's this incentive for banks to make risky loans because if they pay out, right, if the risk is worth it, then they can make a lot of money. On the other hand, if they don't pay out, sometimes these banks will just be bailed out by governments because they may be considered too big to fail, meaning that if the government allows them to go bankrupt, that can cause big problems in the economy. So banks are extremely important, but because of these risks, they need to be pretty highly regulated. And that sort of back and forth has been one of the stories of the 20th century, where we had low regulation, financial crash, high regulation, safe but less profitable banking. We got rid of some of that regulation, rid of it, financial crash, right? And so the balance between those two is extremely important.